stop for a second before you look at oil, before you look at gold, before you look at the S&P 500. Ask yourself a harder question. What if the most dangerous target in the Middle East right now is not an oil field at all? What if it is a water system that sounds less dramatic than a missile striking a refinery? So most people skip past it, but that is exactly why it matters. The big risks rarely arrive wearing the costume everyone expects. They arrive through the quiet dependency that nobody thinks can fail until it does. And in the Gulf, water is not a side issue. It is the system underneath the system. People hear Middle East crisis, and they immediately think tankers, pipelines, Hormuz, gasoline prices, maybe inflation at the pump. All of that matters. But if you stop the story there, you miss the real mechanism. Gulf economies do not just run on energy. In several of these states, daily life runs on desalination. Remove that, and you are not squeezing profit margins. You are threatening the basic habitability of modern urban life. That is the first thing I want you to hold in your mind. The second thing is this. Even that is not the final story, because the market that could transmit this shock into American retirement accounts is not in the Gulf. It is in Japan. And the reason that matters is brutal in its simplicity. Japan cannot print oil. Japan cannot tolerate a collapsing currency forever. Japan cannot raise rates aggressively without endangering its own debt structure. And Japan happens to sit on the largest foreign pile of US Treasuries on Earth. That is the chain water pressure in the Gulf energy shock. Yen stress in Tokyo, Treasury stress in the United States. I want to walk through that chain slowly, because once you see it, you stop looking at this conflict the way television wants you to look at it. Let me start with the first mistake almost everyone is making. They are watching the Strait of Hormuz as if the whole story is contained in oil supply. They model how many barrels move through the strait. They estimate how high crude could go. They tell you gasoline could spike. They talk about shipping insurance, tanker delays, panic buying, and reserve releases. Fine, that is the visible layer. But the deeper layer is that many Gulf states are held together by energy, powered desalination. That means electricity, pumping systems, distribution infrastructure, and water treatment networks are not just economic assets. They are survival assets. If you can threaten the grid that powers the desalination plants, if you can disrupt the pipes, if you can force fear around the operating system that keeps fresh water flowing, then you are no longer just threatening an export machine. You are threatening the social contract. Oil shocks make people angry. Water shocks make states unstable. And that difference matters, because an unstable Gulf does not just create a short-term commodity spike. It creates a sustained repricing of regional risk. Investors stop asking whether oil will jump for a week. They start asking whether the basic operating assumptions of the region are safe at all. That pushes us to the next layer. If the region becomes structurally riskier, energy prices do not just blip. They stay elevated. Shipping becomes more expensive. Insurance becomes more expensive. Hedging becomes more expensive. Emergency stockpiling becomes more common. And suddenly the countries that depend most heavily on imported energy are not facing a headline shock. They are facing a policy trap. Japan is the purest example of that trap. Japan is one of the most important countries in the world and one of the most misunderstood. People talk about Japan as if it is stable by default. They see order, low drama, institutional competence, and they assume that means resilience under any condition. But stability can hide fragility. Japan imports nearly all of the energy it burns. So when oil surges and the dollar strengthens at the same time, Japan gets hit twice, first through the commodity price, then through the currency translation of that commodity price. That is what makes this crisis so dangerous for Tokyo. Brent can say one number on the screen. Japan can still experience a much uglier number in practice because the yen is weakening while the import bill is rising. A country that cannot produce the fuel it needs is forced to buy crisis-priced energy in a currency that is losing credibility. That is not a normal inflation problem. That is a balance sheet problem. Now ask the next question. How does a government usually defend a falling currency? Normally, it raises interest rates. It makes the currency more attractive. It signals seriousness. It imposes pain now to avoid something worse later. But Japan cannot use that tool cleanly because Japan is sitting on one of the most debt-heavy public balance sheets in the developed world. Higher rates are not just a currency defense. In Japan's case, they are a fiscal danger. Raise rates too hard and the debt service math starts to look frightening very quickly. So Japan is trapped between two fires. If it does not defend the yen, imported inflation worsens and energy pain multiplies. If it does defend the yen aggressively with rates, it can destabilize its own sovereign financing structure. That is where the story turns from a Japanese problem into your problem. because when a government is cornered, it stops choosing from ideal options and starts choosing from available ones. And one available option for Japan is intervention funded by selling dollar assets. That means treasuries. This is the piece most people are still not taking seriously enough. Japan is not just another stressed importer. Japan is the largest foreign holder of US government debt. That pile matters all the time, but it matters even more in a moment when treasury yields are already sensitive, inflation is already sticky, and Washington is already carrying heavy fiscal strain. So now put the whole structure together. A Gulf crisis threatens water and energy systems. Energy prices stay high. The yen weakens further. Japan faces pressure to act. Japan sells some treasuries to defend its system. Treasury prices fall. Yields rise. And once yields rise hard enough, the damage stops looking like geopolitics and starts looking like your mortgage quote, your credit card APR, your auto loan, your company as financing cost, and your portfolio valuation. That is how the story enters the American household, not through a dramatic breaking news chyron, through yield transmission. That is the mechanism under the mechanism. And it gets worse because treasury stress never shows up alone. It collides with other existing fractures. It collides with a Federal Reserve that still has to think about inflation credibility. It collides with a U.S. government that has leaned heavily on debt issuance. It collides with corporate refinancing needs. It collides with equity valuations built on the assumption that rates will eventually become more friendly, not less. This is why I do not think the right frame is oil shock. The right frame is allied stress transmission. America does not have to lose a war in the Gulf to feel serious domestic pain from this crisis. It only has to force enough pressure into the system that one of its own key allies is compelled to act in ways that reverberate back into the treasury market. That is the uncomfortable truth. The weakest point in a stress system is not always your enemy. Sometimes it is the ally tied most tightly into your financial architecture, and Japan is tied into America's architecture at exactly that level. Now, I want to be fair and precise here. A full-scale treasury dump is not guaranteed. Anyone who tells you Japan will definitely unload everything is selling theater, not analysis. States do not behave like angry day traders. They move carefully, they signal, they sequence, they try to avoid detonating the very markets they depend on. But uncertainty is not safety. The fact that a total liquidation is unlikely does not make partial selling harmless. In markets like this, you do not need the maximum scenario to produce real damage. You only need enough selling to push yields into a zone where the rest of the system starts repricing at once. And we have seen how quickly that can happen when long-term yields cross psychologically and politically sensitive levels. Washington notices, the White House notices, investors notice, corporate treasurers notice, housing notices. That is the point where the story stops being maybe something bad happens later and becomes something is tightening right now. There is another layer here that matters. The longer energy stays expensive, the more this pressure compounds. Japan is not dealing with one ugly trading session. It is dealing with the possibility of a sustained imported cost squeeze. That is what turns a difficult week into a policy event. And once policy events begin, the next thing that wakes up is leverage. Carry trades unwind. Funding costs move cross. Asset volatility spreads. Safe havens stop behaving in clean, comforting ways. This is why retail investors usually understand the story last. Institutions reposition while everyone else is still arguing about whether the original headline is overblown. By the time the average person finally realizes the shock has moved from geopolitics into market plumbing, the repricing is already underway. That is why I think the real object to watch in this crisis is not the first order chart everyone is staring at. Yes, oil matters. Yes, shipping matters. Yes, the Strait of Hormuz matters. But the thing that can carry this conflict directly into the center of the global financial system is the stress it imposes on Japan. And the thing that makes that stress so dangerous is not just Japan itself. It is Japan's position inside the architecture of American finance. A lot of people still believe the United States can absorb a Middle East shock because America is stronger, richer, more diversified, and less directly exposed than the countries living around the Gulf. That is an incomplete reading. America may be less directly dependent on the region than some allies, but America still sits at the center of the debt market everyone prices off. If a crisis in the Gulf transmits through Japan into treasuries, the United States does not stay outside the blast radius. It becomes the place where the final pricing happens. And that pricing is merciless. Higher yields do not ask whether you followed foreign policy closely. Higher yields do not care whether you own energy stocks. Higher yields do not care whether you think the war will be resolved soon. They simply tighten conditions. They raise borrowing costs, they compress valuations, they force weak hands to adjust, and then they reveal who was pretending risk was contained when it was actually spreading. So where does this leave us? It leaves us watching three things at once. First, whether the Gulf crisis remains an oil story or becomes openly a water and infrastructure story. Second, whether energy prices stay hot long enough to deepen the yen problem. Third, whether Tokyo begins moving in ways that tell you the pressure is no longer theoretical. That is the board. Not one headline, not one war or chain. And the dangerous part about chains is that they break at their most stressed link, not at the most obvious one. Everybody is watching Tehran. Smart money is watching Tokyo. Because if Japan is pushed hard enough, the shock does not stay in Asia and it does not stay in the Middle East. It lands in the treasury market. And once it lands there, it is no longer their problem. It is yours.